Gary, thanks for being with us.
My pleasure as always. I'm glad to be here and share what information I can with the viewers of Chart This.
So Gary, when we saw each other last, you brought us part 1 of your Outlook 2014 series. We'll get to part 2 today. But before we get to that, how are things set up for you right now?
In terms of how things are set up right now, of course, we just had an announcement last week that the Fed is actually going to begin the tapering process. But the key is that they're going to taper. They're going from 85 billion to 75 billion in terms of their monthly purchases. But that's had a dramatic effect on the precious metals markets as we saw them slide below 1,200 and really go to the recent lows of 1181. The other thing that the Fed said that I found relevant is the fact that they are going to work to maintain low interest rates. And of course, low interest rates are a bearish scenario for the precious metals markets. Because I believe that we're currently in our 5th wave in terms of our bear count, our Elliott wave count, I am looking for the market to either bottom at around 1181 to 1150. If it cannot hold that area, 1042 is the next area we would logically look at. But that's a bridge that we should cross when we get there. So I do believe that through the end of the year, we could see lower pricing and we could stay under $1,200 in terms of the base price of gold.
All right, and before we jump right into your series, Gary, if I had to ask you to pick one metal that you think could really outperform in 2014, or at least at the start of the year, which one would you say it is?
If I had to pick a metal that I believe would perform well the first part of next year, I would absolutely look at metals, the precious metals, that are highly used in industry, such as platinum, palladium, and to a degree silver. The reason and the rationale behind that is with a very, very strong equities markets and the fact that the auto industry in the United States has had a dramatic recovery. These are significant metals that will be needed to continue to build new cars and to work with industry as they need these raw products to produce their components or their end products. And so for that reason, I would look at the precious metals next year that had an underlying need in terms of different industries. Platinum would be the one that really sticks out.
All right, on that note, Gary, let's get to part 2 of your Outlook 2014 series.
Yes, today's insert is going to be part 2 of our Outlook 2014. I will be looking at my call for next year, and we're also going to do a short analysis of the equities markets, the gold market, and quantitative easing, because at different parts as they established quantitative easing, we had the equities and gold running in tandem, and then we did have a dramatic divergence this year, 2013. So I think that that is worth noting. Hello, Chart This viewers, and welcome to our last edition for 2013 of Chart This. On today's show, this is going to be part 2 of Outlook 2014, which we began on our last show. In part 1 of our Outlook 2014, we were looking at 2 basic models. Both models were Elliott wave based, and they both put us in a current wave count in which we were in our last terminating wave, or wave 5. We looked at it as this: 1, 2, a long wave 3, 4, and our current wave 5. The difference between the 2 models that we looked at were that on one model, we assumed that we would have what is simply called a truncated bear market. And on a truncated bear market, in essence, you get equal lows or very, very close to equal lows on waves 3 and 5. And from there, you go into your A, B, C correction. On a bear market count, of course, it is A, B, and C. So it's a rally to the upside. That's a corrective pattern when you're looking at a bear market. The second of the 2 models that we looked at assumed that we would have really more of a standard zigzag. And on a standard zigzag, the differentiation is you've got wave 3. Here's our low at 1181, wave 4. and then we have wave 5, which gives us a new low. On that particular model, we would be looking to breach the current low that we have, which is 1181. Last week, of course, as of Thursday, we were looking at a market trading $10 off of that at 1191. So then on that particular model, we could see a new low as shallow as, call it 1150. That is our 61% retracement, and that is a pretty long retracement because it's a retracement from 700 up to 1900, and that is a pretty critical area. My sense is that if it holds there, we would get a standard 3, 4, and then 5. The other option, of course, on that particular model is you have an extended fifth wave rather than a truncated fifth wave, and if that were to emerge, we could see the market dip as low as maybe 1,050. However, that is a scenario in which I would only look at if we breached this 1150 mark, this 61% retracement. Now, from those two models, we can forecast or calculate where we think an ABC upside rally might take the price of gold. But before we do that, I want to look at one observation that I find quite interesting as we close out 2013, and that really is the relationship that we have seen between gold, the equities markets, and quantitative easing, or our current monetary policy. All I've done is put up a weekly chart of spot gold on the top. On the bottom, we're looking at the Standard & Poor's chart, a weekly chart also, and then little markers for the different parts of our quantitative easing program. And if you recall, we had a stock market that was really rampant and running pretty solid. This is 2003, and really we got to record and all-time highs at 2008. If we look at gold's performance, gold was pretty much running in tandem also, because you had the market genuinely from 2003 up to about 2008, that same point, trading higher. We had a collapse, of course, the collapse in the stock market, and as the stock market collapsed through 2008, it affected not only the equities markets, but it affected gold, and we saw gold drop dramatically in price, and this is where gold prices dropped back down to about 700 after reaching 1,000 for the first time. Quantitative easing starts at the end of 2008. In terms of the equities markets, initially you had a small spike, but then it continued to drop through the first part of 2009, and then 2009, 2010 were really characterized by a tremendous rally, and we saw gold and the equities markets really moving in tandem. Right before 2011, quantitative easing 2 or QE2 begins. That continues the rally in the stock market. We get our parabolic rise in gold, takes us to the record top, and during this particular period, we had the equities markets drop, we had gold drop at the same time, but the equities continue to rise. And in fact, as they continue to rise, my belief is that much of the liquidity or equity dollars, investment dollars in gold began to move into the equities markets. So we saw a continuation of the equities markets really improving, and that was part and parcel because our economy was starting to improve. And what we were really seeing here were the effects of quantitative easing working, in that it was ramping our economy up, the employment rate was going down, and the numbers that were coming out were positive and favorable, of course. QE3 is very interesting because that's when they began a bond purchase of roughly, it started at 40 billion and concluded at about 85 billion on a monthly basis. And the interesting thing is, at that point, we get a major divergence in terms of the direction of the equities markets and the direction of gold, because the equities markets continue to ramp up and move to higher ground. And really, as QE3 takes into effect and the economy really starts to ramp up, the reports become more positive, you get this incredible divergence between gold, which is moving down, and the equities, which are moving up. The reason I believe that that is so important is because what has occurred right now, just prior to the conclusion of 2014, is the announcement of tapering. So we're going from 85 billion on monthly purchases to 75 billion on monthly purchases. And although that is not a lot, because the debt that has been accumulated by the Fed over this entire period of time is now, I believe, in excess of $3 trillion. That's the asset purchases over this period of time. You have the economy in such a place right now that they begin to taper because it's not as necessary, but still necessary to continue to see improvements in the economy. With that in mind, that being said, it increases the probability that we will see continued bearish pressure on the gold market as we move into 2014. As tapering begins, if the economy continues to move up, we've got this tremendous divergence where equities continue to rise, but the metals continue to be under pressure. Tells me that at least for the first quarter of 2014, we could still continue to see the precious metals under pressure. So, based on the models that we have presented to you, the following are our forecasts for 2014. The first model is going to assume that our third, our fourth, and our fifth wave are all within a defined range, having a low that does not exceed 1150. That is a 61% retracement. If in fact that is how we unfold, and realize I'm talking about hitting a low of 1150 somewhere around the first part of next year, we would get some sort of an A, B, and C progression. What I have done is placed on the right-hand side a fib retracement, which is from the beginning of the bear count to the conclusion at 1150, and our most shallow model in terms of that ABC would take the market after we conclude and terminate our fifth wave back to around 1302 on the low side to a high of around 1400. Our secondary model starts from the beginning of our bear count but takes the market to 1040. And based upon that model, our ABC progression would take us back to anywhere between 1219 and 1330. And 1330 is a fairly important number. So based upon our two models, if we get that bear truncated, or that what I tend to call a flat, 3 and 5 are equal, you can look for a rebound in the market to take gold prices anywhere between 1300 and 1400. If we do break this low at 1150, I believe we could see another $100 to the downside, and in that case our ABC would take us back to 1219 to 1330. It's been an absolute pleasure to be able to come to the audience at Kitco and present our chart a couple of times a month over this last year. Hope you've gained some great insight. We do, as we always do, have additional content, and this will be part 2 of the final outlook, and it will be available for viewing, of course, on our website, thegoldforecast.com. If you log to thegoldforecast.com, under the commentary section, you will see after the show. If you go ahead and click that, that will get you to our bonus content. You can see the part 1 and part 2 are already in, and by the time you come and view this, you'll be able to view part 2 and part 2 after the show. Want to wish all of our viewers a happy and prosperous holiday, and thank you so much for watching Chart This.
All right, Gary, thanks so much for that.
I wanted to wish all of our Chart This viewers and the Kitco staff a very, very Merry Christmas and a happy and prosperous New Year and following year. I do wish that all of our Chartist viewers are surrounded by family, health, and wealth. Have a great day, and again, happy holidays.
Thanks again, Gary. We'll see you in the new year. In the meantime, to all our viewers, please email us any comments or questions or topics you'd like covered in 2014 at newsfeedback@kitco.com or follow me on Twitter at Daniela Camboni. Thanks for watching and season's greetings.